Welcome to Day 20 of Future Business School's Daily MBA series. Today's topic is corporate finance. Corporate finance is all about how businesses manage their finances with a focus on making decisions that increase shareholder value. The three core elements we'll cover today are capital structure, cost of capital, and financial leverage. Let's dive right in. What is corporate finance? Corporate finance is the area of finance that deals with the financial decisions companies make and the tools and analyses used to make these decisions. The primary goal is to maximize shareholder value by managing the company's capital effectively. It includes decisions on investment, financing, and dividends. Step 1. Capital structure. The capital structure of a company refers to how it finances its overall operations and growth using different sources of funds. This is a mix of debt and equity financing. The right balance of debt and equity is crucial because it affects the company's risk profile, cost of capital, and overall value. 1. Equity financing. Equity financing involves raising money by issuing shares of stock. Investors who buy shares gain partial ownership in the company and typically expect a return on their investment through dividends or an increase in stock value. Pros: no obligation to repay investors, less risk of bankruptcy. Cons: dilutes ownership for existing shareholders. Paying dividends can reduce available funds for reinvestment. Example: tech companies like Facebook or Google often use equity financing, especially during their early stages, to avoid taking on too much debt. Debt financing involves borrowing money that must be repaid with interest. This could be in the form of loans, bonds, or other debt instruments. Pros: interest payments are tax deductible, no dilution of ownership. Cons: must make regular interest payments, increases the company's financial risk. For example, companies like Tesla have used debt financing to fund new gigafactories. They issue bonds to raise billions in debt while still retaining full control of the company. The optimal capital structure is a balance between debt and equity that minimizes the company's overall cost of capital and maximizes its value. Different industries may have different optimal structures. For instance, capital-intensive industries like utilities may rely more on debt, while tech startups often favor equity. The cost of capital represents the cost a company incurs to finance its operations through debt and equity. It's a critical concept because a firm must earn at least this cost to create value for its shareholders. The weighted average cost of capital, or WACC, is the most common measure. Weighted average cost of capital, or WACC, is a weighted average of the company's cost of debt and equity. Here's the formula. WACC equals the market value of equity divided by the total market value of the company multiplied by the cost of equity plus the market value of debt divided by the total market value of the company multiplied by the cost of debt and then multiplied by 1 minus the tax rate. E represents the market value of equity. D is the market value of debt. V is the total market value of the company, which is E plus D. The cost of equity is the required return on equity using models like CAPM. The cost of debt is the interest rate on the company's debt. The tax rate is the corporate tax rate because interest is tax deductible. For example, if a company has $1 million in equity and $1 million in debt, and the cost of equity is 10%, the cost of debt is 5%, and the tax rate is 20%, then the WACC would be WACC equals 1/2 times 10% plus 1/2 times 5% times 1 minus 0.2, which equals 7.5%. This WACC tells us that the company must earn at least 7.5% on its investments to satisfy both its debt holders and equity holders. The importance of WACC cannot be overstated. A company with a lower WACC can pursue more profitable investments because its hurdle rate, or the minimum return required, is lower. On the other hand, a high WACC may mean the company is using more expensive debt or equity and must focus on higher return investments to add value. Step 3 is financial leverage. Financial leverage refers to the use of debt to amplify returns on equity. When a company uses debt, it can increase its potential returns to shareholders, but it also increases the risk. A company with a high level of financial leverage has more debt relative to its equity. Leverage ratio. The leverage ratio is a measure of how much debt a company has relative to its equity. It's often expressed as the debt-to-equity ratio. Debt-to-equity ratio equals total debt divided by total equity. For example, if a company has $2 million in debt and $1 million in equity, its debt-to-equity ratio is 2 million divided by 1 million, which equals 2. This means the company has twice as much debt as equity. Pros and cons of financial leverage. Let's start with the pros. Financial leverage can amplify returns for equity holders if the company's returns exceed the cost of debt. Now for the cons. It also increases the company's risk, particularly during downturns. High debt levels can lead to financial distress if the company cannot meet its debt obligations. Real-world example: Amazon's leverage strategy. Amazon is a great example of a company that has used financial leverage wisely. In its early years, Amazon took on significant debt to fund its rapid expansion into new markets and technologies, but it balanced that debt with growing revenue streams. Amazon's ability to manage its debt while generating massive growth allowed it to eventually pay off much of its debt, keeping leverage under control. Case study: Apple's capital structure. Apple is often cited as an example of a company with a well-optimized capital structure. The tech giant uses both debt and equity strategically. Although Apple had little debt for many years, it began issuing bonds in 2013 to take advantage of low interest rates, even though it had massive cash reserves. This move allowed Apple to return cash to shareholders via stock buybacks and dividends without repatriating foreign earnings and facing high tax penalties. Apple's cost of debt was very low due to its high credit rating, and issuing debt allowed it to reduce its WACC and maximize shareholder value. Despite its reliance on debt, Apple's financial leverage remains conservative, ensuring it stays financially flexible. Conclusion and key takeaways. Corporate finance decisions on capital structure, cost of capital, and financial leverage are crucial to managing risk and maximizing value for shareholders. Finding the right balance of debt and equity, understanding the cost of financing, and using leverage strategically can help a company grow while managing risks. Key takeaways. The capital structure involves the mix of debt and equity used to finance a business. The cost of capital, measured by the WACC, represents the minimum return a company needs to generate for its investors. Financial leverage amplifies both potential returns and risks and should be used wisely. Thanks for watching today's episode on corporate finance. Make sure to like, share, and subscribe to Future Business School for more insightful business content. In the next video, we'll be diving into investment appraisal and how companies assess the viability of new projects. Make the background music engaging. Use only copyright-free music.